Hi, and welcome to Dollars and Making Sense, a weekly radio program about finance, money, and investing on Radio Northern Beaches and broadcast nationally on the Community Radio Network around Australia. I'm your host, Ray Treverson from OTG Capital, and today we're welcoming to the microphone Josh McMullen, tax practitioner and writer with the Institute of Financial Professionals Australia, formerly known as Tax and Super Australia. Josh, this is your first time to the radio show. Welcome.
Oh, thanks for that, Ray. It's good to be here. Yeah.
Wonderful. Now, one of the things that I often get asked about, Ray, is it exciting talking about tax and the like? And I guess I say to people, look, it can be pretty boring if you think it's boring that you pay too much tax or the like. But I think it's excellent if you start learning about all the good things that are out there with regards to maximizing your tax deductions and I guess looking at all the different aspects about managing your tax bill. Now, Josh, how long have you been at IFPA for?
I've been at IFPA, I've been at IFPA since about 2018. I was sort of part-time contractor from 2018 to 2021. And I had another job on the side, but I was contracting to IFPA from 2018 to 2021. But at the end of 2021, I took on a full-time role at IFPA, and I've been there ever since. So about 18 months now, full-time, yeah.
Wonderful. So how long have you been involved in tax practicing and writing about tax?
I've been involved with tax since I graduated from university in 2001. So I started off my career at the tax office under the graduate program. And then I went into writing private binding rulings for the tax office until 2005. And in 2005, I resigned from the tax office and took up a writing and tax consultancy job with a bookkeepers network. And I was there from about 2006 to 2021, sort of writing
Wow.
writing tax publications for the bookkeepers network. And as I explained earlier, I took on a full-time role at Institute of Financial Professionals Australia in 2021. So I guess I celebrated my 21st anniversary.
Okay, well, that's look over 20 years of experience. That's excellent. So, look, today we've asked you onto the show to talk about temporary full expensing. Now, this is a subject actually near and dear to my heart because I am a small business owner. And I guess one of the things that kind of surprised me when I looked at the definitions within the tax office rulings around small businesses, they're not quite that small, are they?
No, that's right. Yeah, I mean, temporary full expensing is a case in point. One of the eligibility criteria is that you've just got to have a turnover of under $5 billion. So
Yeah, that's with a B. That's with a B, ladies and gentlemen. Billion. So that's $5,000 million. Like, wow. So it's pretty well open to pretty well most companies in Australia, isn't it?
That's correct. Yeah. That $5 billion does include connected and affiliated entities in your turnover, but even allowing for that, yeah, the vast majority of businesses come in under that $5 billion threshold. So yeah, it is temporary full expensing is quite a generous measure in terms of its accessibility.
So I guess in doing my homework, ladies and gentlemen, I always get homework from my interviewees. So I like to do my background reading, and I like this. It's a simplified and very generous way to write off or depreciate assets that you use in your business. Now, Josh, why was this introduced, do you think, in essence, it's now the previous government, but I think it's certainly been kept. So why was this introduced?
Well, it was introduced in the federal budget, which in 2020 was held on the 6th of October. and it was very much connected with the COVID-19 downturn. I think that just to allow businesses, to give them a bit of a break in terms of their cash flow. Before it was introduced, just to give you some idea, the write-off threshold was $150,000. So you can only write off assets immediately if they cost $150,000 or less. And that measure was only available to businesses with a turnover under 500 million. So it was available to less businesses, and it was very much less generous, only having a threshold of 150,000. But yeah, with the onset of COVID-19, there are a number of tax measures that were made much more generous, and certainly temporary full expensing falls into that category, coming on stream as it did in October 2020.
And so, given your experience, Josh, do you see that many businesses have taken up this option to use TFE, to use a three-letter acronym, temporary full expensing? Is this something that people are using a lot, or are they still sort of not dawned on them that this is available?
No, it's encouraged a lot of businesses to invest. The key with temporary full expensing is that it doesn't actually give you additional deductions, but it just allows you to bring forward your deductions into the first year that you use the asset in your business. So a business shouldn't go out and buy additional assets that were not within its business plan, because you don't get any additional deductions. You just get your deductions quicker. So you should, most businesses have stuck to their business plan and just bought assets that they were going to buy in the first place. But if they've had a line ball call on whether to buy an asset or not, then yeah, temporary full expensing certainly encourages them to make that call and invest in their business. So yeah, it's a real assistance for the cash flow of a business, rather than giving a business any extra deductions. And cash flow is one of the leading causes of small business failure. So, and when something assists your cash flow, it's very much a good thing for small business.
So one of the things that fascinates me, Josh, is that Dollars and Making Sense as a radio show, we've been going just a bit over 4 years now. And I know when we first started the show, as part of our remit to try and educate people, one of the things that I found on Twitter, of all places, I'm a big Twitter user, was that when the full expensing came out, it was something that the politicians at the time made a big deal about it. And the misconceptions out there that, and particular when I saw this on Twitter, there were tradies out there thinking, great, we're going to get a check. At that time, I think it was either $15,000 or $25,000. They were expecting checks in the mail because of whatever they thought was going in their heads. And I think it's really clear to make to people, this doesn't give you any extra cash in your pocket. It simply brings forward when it's going to happen, isn't it?
That's right. Yeah, it brings forward your deductions, so it decreases your business's taxable income in the first year that the asset's installed, ready for use in your business. But as you say, the perception when it first commenced was that the government actually sends you out a check for but that's not the case. It's just the effect of it is to bring forward your deductions that you would otherwise have been entitled to, but those deductions, before temporary full expensing, those deductions could have been drawn out over a number of years. But yeah, there's certainly no check in the mail from the ATO under temporary. It's just,
I have to say, Josh, I had a laugh, but then I think on the serious side of things as well, this misconception, and dare I say, there were a few naughty pollies out there that didn't rush out to quell and say, oh no, no, no. They just simply let sleeping dogs lie, and if the perception was misunderstood later on, they just shrug their shoulders and go, well, you talk to your accountant. Obviously, you've got to get proper financial advice. And that's what we always say here on Dollars and Making Sense. If you're not sure about what you're doing, always seek professional advice. And certainly in this space, I always, myself included, I always go back to my accountant. But I guess we've talked about cash flow as one of the benefits. What are some of the other benefits of temporary full expensing, Josh?
Okay. Yeah, basically, it simplifies your record keeping is another benefit. It's rather than having to keep track of deductions, rather than having to keep track of the amount of deductions you can claim over a number of years and the effective life of the asset. Basically, you can just depreciate in your first year and then forget about having to keep records over the subsequent years. So it definitely does streamline a business's record keeping and just makes the whole deduction process just very simple. Just claim your full deduction in your first year that you're using the asset, and then you can forget about having to go through what can be complex calculations to work out your deductions for subsequent years. So just to recap, there is the cash flow benefit. And in addition to that, there's the simplification for business. You don't have to delve into calculations in subsequent years or go through how long you've held the asset. You can just claim upfront, and that's the end of the matter.
Yeah, I must say I'm a big advocate for this kind of expensing, because when I started my own company probably over 22 odd years ago, in fact. And so when I first bought, things like office furniture and a carpet and a computer and a few other things, and then having to keep this register and a spreadsheet. And I think at that time I had to work out whether it was declining value or a fixed value depreciation. And I was sitting there scratching my head going, my God, and I'm looking at my accountant going, but I've incurred this expense right now. I want to be able to write it off immediately. And they're going, no, it's going to take you 3 or 4 or 5 years, depending on, and again, you had to know what kind of asset declined over what period of time. And
That's
my
right.
word, I guess it's made life a lot easier, hasn't it?
Oh, it has. Just on that, the threshold not so many years ago used to be $1,000. So when you think of business assets, a lot of them are over that $1,000 threshold. So as you say, people were keeping spreadsheets, and all sorts of different calculations were required to work out your depreciation claims when that threshold was back at $1,000. It did, as you allude to, it increased to $20,000, then $25,000, and then it went to $150,000. But now under temporary full expensing, it's unlimited. So there's no need for those spreadsheets.
Happy days.
Yeah.
And so, look, this is a good time. It's time for a break. You're here on Dollars and Making Sense. I'm Ray Treverson. And at the microphone, I have Josh McMullen from the Institute of Financial Professionals Australia, who is a tax practitioner and writer. And we are talking about temporary expensing, full expensing. And we'll be back after this short break. Hi, and thank you for listening to Dollars and Making Sense, a weekly radio program about finance, money, and investing on Radio Northern Beaches and nationally on the Community Radio Network around Australia. The views, comments, and opinions aired during our program should not be construed or viewed as financial advice. Any commentary is general advice only and does not take into account your objectives, financial situation, or needs. You should consider whether the advice is suitable for you and your personal circumstances. If in doubt, you should contact an authorised licensed financial planner. We welcome questions and feedback, and you can get in touch with us via our blog, social media channels, or email. Please search for Dollars and Making Sense in your favourite podcast platform, or check out our blog at otgcapital.com.au/blog. And welcome back, ladies and gentlemen, to Dollars and Making Sense. I'm Ray Treverson from OTG Capital, and at the microphone today, I have Josh McMullen, tax practitioner and writer and specialist with the Institute of Financial Professionals Australia. And we are talking temporary full expensing. Now, I've got to say, Josh, whilst we were taking that short break, I'm always amazed by people when they hear these kind of terms and that they're a little bit bemused and don't know where to start. So if, for example, there is a small business owner out there, and considering that here on Radio Northern Beaches and the CRN, Community Radio Network, a lot of the people that listen to us are small business owners, where's the first place they should go to, I guess, to start this process of understanding about temporary full expensing?
Well, the first place you should generally go to is your accountant or registered tax agent. They'll be able to guide you through the various eligibility criteria and the effect that temporary full expensing can have on your business. Another free source of information is the tax office website. Often people are a bit intimidated to deal with the tax office, but
Yeah, they don't want to call up the evil empire, do they?
That's correct. That's correct. Yeah. And the good news is you don't have to call the evil empire. You can go to their website, and there's very helpful information on their website around temporary full expensing. Not just information, but not just written information, but there's also some very handy videos that you can access as well, and that takes you through eligibility, eligible assets, and that sort of thing. So yeah, the tax office website is a really good place to sort of get a good handle on it, get a good overview of temporary full expensing. And of course, you can always go to various associations like Institute of Financial Professionals Australia, where I work, and
a bit of a shameless plug there, but given you're from IFPA, I'd be surprised. But as an advocacy group, I don't mind in that regard.
Yeah. And
so one of the things that I read as well on the website, and again, I'd really reiterate this, ladies and gentlemen, the tax office website, I've watched many of their videos. They're very informative. They're easy. There's no jargon in it in that regard. And so one of the things that I think that would be very attractive to a lot of mum and dad and small business owners is this applies to second-hand assets as well, doesn't it?
That's correct. Yeah. You don't have to shell out for a brand new asset. It applies to second-hand assets as well, and those assets are just as depreciable as new assets are. So if you buy a second-hand asset for $40,000, say it's a piece of equipment or machinery or furniture or whatever, you can that it's a second-hand asset doesn't preclude you from using temporary full expensing and writing off the cost of that second-hand asset in the year that you first use that asset in your business or have it installed ready for use. So yeah, it's very handy that it applies to second-hand assets as well as new assets.
So, look, one of the things that many businesses buy, me included, are vehicles. And whilst we said in the first half of the show, it is a limitless expensibility, that's one of the things that there is a cap on. Now, I actually looked up the car limit. Even in today's terms, it's roughly about 65K, and it probably gets incremented for CPI. But I guess there are aspects of some limitations around that, isn't there, Josh?
And that's correct, yeah. Basically, for motor vehicles or for cars, even though temporary full expensing is in place, you can only depreciate a car up to the car limit. And as Ray has just referred to, the car limit for the current financial year is $64,174. So you can still use temporary full expensing to claim an immediate deduction, but you can only claim it up to that limit of $64,174. The rest of the car is not depreciable, and that's always
So
been
so
the
I
case.
so I can't go out and buy that Lamborghini and depreciate 64K for the next sort of 4 or 5 years. That doesn't work, does it?
That's right, yeah. In that sense,
Darn.
in that sense, car salesmen, who would have thought car salesmen, when they come on with their commercials about claiming the full cost of the vehicle, it's slightly misleading in the sense that it is capped to that car limit of $64,174.
Yes.
Who would have thought a car salesman would provide slightly misleading information?
Well, I always love to harp back to one of my favorite politicians from the 90s. The devil is in the detail, PJK. Mr. Keating used to say, the devil is in the detail. Now, interestingly, in some of the background reading I've done in preparation for today, is temporary full expensing compulsory? Is this something that small businesses have to do? And if they don't, why would it be advantageous for them to not do it?
Okay, basically, temporary full expensing, whilst it's very beneficial usually, it is not it's not actually compulsory. You can opt out of it. Small businesses, if you're a small business like a turnover of under $10 million, you can't opt out of temporary full expensing on an asset by asset basis. You must opt out of simplified depreciation altogether. So you won't be able
Oh,
to
right.
use temporary full expensing for any assets. But if you're not a small business, turnover of more than $10 million, you can opt out of temporary full expensing on an asset by asset basis. And whilst it's very favourable, there are a number of, whilst TFE's temporary full expensing is very favourable, there are certain circumstances where where it may be advantageous to opt out. And that's where, say you run a business through a trust, by accessing temporary full expensing, you might reduce your income down to nil, and therefore you mightn't have any money to distribute to the beneficiaries. As
Ah.
so yeah, the mum and dad business owner, whilst they operate their business through a trust, they do need those distributions throughout the year in order to live. And yeah, temporary full expensing can substantially reduce your taxable income. And unfortunately, you can't distribute trust losses. It's stuck in the trust. And yeah, temporary full expensing may result in the beneficiaries not enjoying business income during the year. So that's one strong reason. And then businesses businesses may have companies may have franking credits that like to distribute rather than
Mhm.
lose.
Yep.
And if they're in an overall loss position for an income year, they can't use those franking credits. And if you're a sole trader, you may wish to retain. Again, you don't want to reduce your income down to below the tax-free threshold. You generally wish to take advantage of that tax-free threshold, and enjoy like at least $18,000, which is the tax $18,200 of income, and which is not subject to tax anyway because of the tax-free threshold. So, yeah, basically TFE, because it has that effect of dramatically reducing a business's taxable income, you generally don't want that income to be reduced so low that you can't, for example, distribute to beneficiaries of a trust. So, yeah, whilst TFE is very advantageous, you do want to. There are circumstances where it is advantageous to opt out. So.
Well, that's fascinating, I guess, Josh, because most people would always assume that it's best to reduce your taxable income right down to zero. And given that we had one of your colleagues talking about family trusts recently, it was one of those curiosities that struck me in that trusts need to have income to be able to distribute. You can't distribute thin air. And so by reducing your taxable income as TFE would, this temporary expensing, I guess that's one of those considerations that I think everybody that runs these needs to go and have a chat to their accountant. And given, the various stages of the year, tax planning, I think, is something that needs to happen, not just towards tax time, but pretty well the year round, wouldn't you say?
Yeah, yeah. Tax planning is very much a year-round exercise. Most people think of tax planning as claiming deductions just before 30 June to reduce your taxable income.
Yeah,
But
yeah.
as you say,
Doesn't
it
quite
really is.
work that way, does it?
No, it really is a year-round exercise. And if you're using TFE and you haven't opted out, then it can very much have adverse effects, especially when you're running your business through a trust structure, which many mum and dads do. Doesn't just mean big businesses. Many mum and dads run their business through a trust structure, so they need to be aware of the effect that temporary full expensing can have.
Right. So look, it's the old story, the tax man giveth and the tax man taketh away. And this sounds like a very generous scheme. I guess it's going to have a limited future given the dire times we're in. I guess as your final question for today's show, Joss, what do you think the future of temporary full expensing is?
That's a great question, Ray, because at the moment, it's legislated to finish on the 30th of June 2023, which is
Hmm.
only a few months away. And its fate basically will be determined in the upcoming federal budget, where the government will either announce an extension to temporary full expensing, or, as many people think, they'll, because of the budget circumstances, they may reduce that temporary full expensing threshold back to $150,000 as it was before, or
Hmm.
back to $25,000 as it was a few years ago. And interestingly, if they do nothing, then it will revert back to the $1,000 limit that used to apply about 5 or 10 years ago. So yeah, and then
Well,
with that $1,000 limit, for example, you won't get the cash flow benefits, and it'll be very much back to the old spreadsheets that you referred to, Ray, with your record keeping and having to do complex calculations for your deductions over several years. So it's very much a watch this space, watch for the federal budget in terms of whether temporary full expensing will be either extended, made less generous, or heaven forbid, go back to the $1,000 threshold that used to apply. So it's very much a watch this space.
okay. And Josh, that's about it for today. So look, ladies and gentlemen, as always, we like to leave you with some resources. We think certainly the ATO website's a great place to start, as is your accountant and the IFPA website, ifpa.com.au. Josh, absolute pleasure having you on the show to talk about temporary full expensing. That's about our time today. Thanks for listening to Dollars and Making Sense, a weekly program about finance, money and investing on Radio Northern Beaches and nationally on the Community Radio Network Australia. So, Josh, until next time, it's thank you and goodbye.